You know that feeling, right? You look at your payslip, see the income tax, and you think, okay, tax sorted.
Yeah, that's what most of us focus on day to day.
But then you hear about, I don't know, a friend selling a second property, or maybe someone inheriting something valuable,
Hmm.
and you suddenly realize, hold on, there's probably a whole lot more to tax than just what comes off my salary.
That's a perfect way to put it. Income tax and national insurance, they're the basics, absolutely.
But they're just the start.
Exactly. The UK tax system, well, it stretches much further. It touches almost every big financial moment, really, from selling assets to, even just buying things day to day.
Okay, let's unpack this then. Today, we're doing a deep dive into that wider world of tax. The material you shared is brilliant, actually, so much detail.
Yeah, it covers quite a bit. Capital gains tax, inheritance tax.
VAT, stamp duty, corporation tax,
Yeah,
even withholding tax, it's all in there.
it is.
So our mission, really, is to pull out the key bits, try and make these sometimes tricky concepts a bit clearer, give you a shortcut, maybe, to feeling properly clued up.
Absolutely. We want to show not just what they are, but how they actually work in practice, and crucially, flag up those exemptions and reliefs.
Because they can make a real difference, can
A
they?
huge difference, yeah. You'll see, hopefully, that what looks quite dense at first can actually be, well, pretty straightforward once you break it down.
And honestly, there are some quite surprising facts tucked away in here. So let's kick things off with one that often catches people out. Capital gains tax, CGT.
Right, CGT.
For someone completely new to this, what's the simplest way to think about it?
Okay, simplest way. It's basically a tax on the profit you make.
Profit, not the whole amount.
Exactly. The profit you make when you get rid of, sell, give away, transfer an asset that's gone up in value since you got it.
So it's not your regular income. It's about gains on specific things.
Precisely. It's separate from your salary or trading profits?
And what kind of things are we talking about? It's not just any old possession, is it?
No, good question. The sources point to specific categories. Things like personal belongings if they're worth over a certain amount.
Okay.
Real estate is a big one, but not your main home. That's key.
Your main home is usually exempt. We'll come back to that, I guess.
We will. Also, shares, if they're not held in an ISA.
Ah, so ISAs protect you from CGT.
They do. And business assets too, land, buildings, machinery, even things like registered trademarks if they're valuable.
Right. So if I, say, sell a second flat and I've made a profit, how's that gain actually worked out? Is it just the sale price minus the purchase price?
It's a bit more than that, but that's the core idea. It's calculated on your net gains in a tax year.
Net gains, meaning?
Meaning you figure out the gain first selling price minus buying price, plus any costs you had improving it.
Like putting in a new kitchen.
Could be, yeah, enhancement costs. Then, crucially, you can deduct any allowable capital losses you've made in the same tax year.
Oh, so losses offset gains.
Exactly. Or you could even carry forward losses from previous years to reduce the gain for this year.
Okay. And is there like a tax-free amount for these gains each year? An allowance?
Absolutely. Everyone gets an annual CGT allowance. It's called the annual exempt amount.
Right.
That's the amount of gain you can make each tax year, totally tax-free. For trusts, it's usually half the individual amount.
And if you don't use it, does it roll over?
No, that's important. You use it or lose it each tax year. It can't be carried forward.
Got it. You mentioned disposal earlier. You said it's not just selling. What else counts?
Good point. Disposal is broader than just a sale. It includes transferring ownership to someone else.
Like giving it to your kids?
Potentially, yes. Giving an asset away as a gift.
Okay.
Or even if you get compensation because an asset was lost or destroyed, like an insurance payout.
Right. It's basically when it leaves your hands, economically speaking.
That's a good way to think about it, yes.
Now, this is where it gets really interesting for me. I vaguely remember hearing years ago about something called bed and breakfasting in tax circles.
Ah, yes. Bed and breakfasting. That's a famous bit of tax history.
What was it all about?
So in the past, people used to sell shares or maybe unit trusts and then buy them back almost straight away, sometimes even the next day, hence the name.
Why would they do that?
The idea was to deliberately create a gain, or sometimes a loss, to use up their annual CGT exemption for that year. They'd crystallize a small gain, tax-free, without really being out of the market.
Ah, clever. A neat little loophole, then.
It was seen that way, yes. But HMRC, unsurprisingly, moved to close it down.
I bet they did. How?
Well, now, there are rules. If you sell shares or unit trusts and then buy back the same ones within 30 days, it's treated differently for CGT. Basically, those transactions are matched up.
So you can't just sell and immediately repurchase to dodge tax or harvest losses like that anymore.
Exactly. The 30-day rule pretty much put an end to that specific strategy.
Makes sense. Okay, let's shift to the flip side. What's exempt from CGT? This feels really important. Where can people save tax, maybe without even realizing?
This is absolutely crucial, you're right, because the exemptions can be really valuable. The biggest one for most people, their main home.
The place you actually live.
Yes, your principal private residence. As long as it hasn't been mainly used for business, the gain is usually completely free of CGT.
It's a massive benefit.
Huge. What else?
Well, most personal belongings, things like antiques, jewelry, unless they're individually very valuable, there are specific limits.
Okay.
And as we mentioned, anything held inside an ISA, completely CGT-free growth and disposal.
That's a big plus for ISAs.
Definitely. Also, winnings from premium bonds or the lottery, tax-free. Any national savings and investments products. Gifts to registered charities are exempt.
Good to know.
And things like items of national or historical interest if you gift them to the nation. Also, assets transferred when someone dies, they generally escape CGT.
Because they might be subject to inheritance tax instead. Precisely. They fall into the IHT net usually.
That's quite a list of exemptions. Now, what if things go the other way? What if I make a capital loss? Can I use that somehow?
Yes, you can. If you sell an asset for less than you effectively paid for it, that's a capital loss.
Right.
You can use that loss to offset any capital gains you've made in the same tax year. That reduces your overall gain.
And if my losses are bigger than my gains?
Then the leftover loss can be carried forward to future tax years. You can use it against future gains.
Ah, useful. Is there a catch?
There's one key point. When you use carried forward losses, you can only use them to reduce your gains down to the level of that year's annual exempt amount. You can't use them to create a sort of negative taxable gain below the allowance.
Okay, so you still effectively get your annual allowance first.
Yeah.
Got it. Right, the actual calculation. Can we walk through the basic steps? How do you get from a raw profit to the actual tax bill?
Sure. Think of it like steps. First, calculate the gain itself on each asset you've disposed of.
Sale price minus cost plus improvements.
Basically, yes. Oh, and a quick note, if you own the asset before March 31st, 1982, there's a special rule. You often use the value on that date as the cost, not the original price.
Right, for very old assets. Okay, step one, calculate gains.
Then, step 2, deduct any allowable capital losses from the same year.
Okay.
Step 3, deduct any allowable capital losses carried forward from previous years, but only down to the annual exempt amount level.
Got it.
Step 4, deduct the annual exempt amount itself for the current year.
So you've taken off losses, then the tax-free bit.
Exactly. What's left after that is your taxable gain.
That's the amount taxes due on. And how is the tax rate decided?
Step 5.
Yeah.
You add that taxable gain to your regular taxable income for the year. This determines whether the gain falls into the basic or higher rate tax band.
Ah, so your income level affects the CGT rate.
It does. Step 6. You apply the relevant CGT rate. There are different rates, often 10% or 20% for most assets for basic and higher rate taxpayers respectively, but there are higher rates specifically for gains on residential property that isn't your main home.
Okay, that's clear. And when does all this need reporting and paying?
Right. CGT applies to gains made in the tax year, which runs from April 6th to April 5th.
Standard tax year.
Yes. Usually you report these gains on your self-assessment tax return. The deadline for the return and for paying the tax is normally January 31st after the end of the tax year.
So quite a bit of time normally.
Normally, yes. But there's a big exception for UK residential property.
Ah, you mentioned this.
If you make a taxable gain on selling UK residential property again, not your main home, you have to report it to HMRC and pay the estimated CGT within 60 days of completion.
60 days, that's much quicker.
Much quicker. Easy to get caught out by that one.
Definitely. Let's try and make this concrete with that example from the source material. Vanessa.
Right, Vanessa.
She earns £15,000 a year, so she's a basic rate taxpayer. She sold a unit trust, made a £31,000 gain.
Okay.
But she also sold some shares at a loss of £2,000. Her annual exempt amount is £3,000, and the basic CGT rate for her gain is 10%. How does that calculation work out?
Okay, let's follow those steps for Vanessa.
Step 1, the gain.
Her gain is £31,000 on the unit trust.
Step 2, deduct losses.
She deducts her £2,000 share loss. So £31,000 minus £2,000 leaves £29,000.
Okay. Step 3, carried forward losses, none mentioned here. Step 4, annual exemption.
She deducts her £3,000 annual exempt amount, so £29,000 minus £3,000 leaves £26,000.
That's her taxable gain then, £26,000.
That's her taxable gain. Now step 5, check her tax band. She's basic rate, and even adding this gain doesn't push her fully into higher rate for CGT purposes on this type of gain.
So step 6, apply the rate.
She pays tax at the basic rate, which is 10% for this type of gain. So 10% of £26,000.
£2,600.
Exactly. Her CGT bill is £2,600. It shows really clearly how those losses in the exemption reduce the final tax, doesn't it?
It really does. That makes it much less daunting. You mentioned reliefs earlier, too, beyond the main home exemption. Can we touch on those? You said they can be quite impactful.
Yes, absolutely. Reliefs are ways the rules allow you to reduce or postpone your CGT bill in certain situations. We already covered the main one. Private residence relief, the exemption for your main home.
That's the big one for most people.
It is. It even applies to things like houseboats or fixed caravans if that's your main residence. There are rules about garden size and periods of absence too, but fundamentally it protects your home.
What else? Especially for businesses.
Okay, for business owners, there's business asset disposal relief. Used to be called entrepreneur's relief.
Ah, yes, I've heard of that.
If you sell qualifying business assets or shares in your own trading company, you might pay a much lower CGT rate, currently 10% on qualifying gains up to a lifetime limit. It's a significant incentive.
Sounds very valuable.
Then there's business asset rollover relief. This one lets you defer CGT.
Defer, not exempt.
Defer. If you sell certain business assets, but then reinvest the proceeds into new qualifying business assets within a specific window, usually 1 year before to 3 years after the sale, you can roll over the gain.
So you don't pay the tax now, but you might later when you sell the new asset.
Exactly. It helps businesses grow and reinvest without an immediate tax hit.
Okay. Any others? What about gifting assets?
Yes, there's gift holdover relief. This applies mainly to gifts of certain assets, like business assets, shares in unlisted trading companies, or agricultural property.
And how does that work?
Again, it's a deferral. The person making the gift doesn't pay CGT immediately. Instead, the gain is held over, and the person receiving the gift effectively inherits the original cost base.
So the tax liability passes to the recipient, payable when they eventually sell.
That's the idea. It's useful for passing down family businesses or farms, for instance.
Right. We've covered a lot on capital gains tax, from the basics through the exemptions, the weird history of bed and breakfasting, and those important reliefs. It really is about taxing the growth on assets.
It is. And understanding the rules can make a big difference.
Let's switch gears now to another really significant tax area, one that feels perhaps even more personal for many people: inheritance tax, or IHT.
Yes, IHT definitely touches on planning for the future, legacies. It's often quite emotionally charged.
So what is it, fundamentally?
Inheritance tax is mainly a tax on the value of someone's estate when they die.
Their estate being everything they own.
Pretty much property, savings, investments, possessions, minus any debts. But crucially, it can also apply to certain gifts made during their lifetime.
So lifetime gifts could be pulled back in. We need to talk about that. But first, this nil rate band, what's that all about?
The nil rate band, or NRB, is basically the amount of your estate that's taxed at 0%. Everyone gets one.
So the first chunk of your estate is tax-free up to that limit.
Exactly. Currently, it's £325,000 per person. Anything up to that amount, no IHT is due.
And the really interesting part here, I think, is how this band can be transferred between spouses or civil partners.
Yes, this is absolutely vital for couples.
Yeah.
If the first spouse or civil partner to die doesn't use up their full nil rate band.
Maybe because they left everything to the surviving spouse, which is usually tax-free anyway.
Precisely. Then the percentage of the nil rate band they didn't use can be transferred to the surviving partner's estate.
So potentially the second partner to die could have double the allowance, up to £650,000 tax-free.
That's right. It effectively allows couples to pass on more wealth tax efficiently. The mechanism involves claiming the unused percentage when the second partner dies.
That's a huge planning point. And then on top of that, there's the residence nil rate band that came in more recently.
Yes, the RNRB. Introduced from 2017-18. It's an extra nil rate band.
Specifically for property.
Specifically for when a main residence, a home, is passed down to direct descendants.
Children, grandchildren.
Yes, it provides an additional allowance on top of the main £325,000 NRB, but only against the value of the home being inherited by those direct descendants.
Is it the same amount for everyone?
It's currently up to £175,000 per person, but it tapers away for very large estates, those worth over £2 million. Like the main NRV, any unused RNRV can also be transferred between spouses or civil partners.
So potentially, a couple could pass on a £1 million estate, including their home, completely IHT-free. 325K plus 175K by 2.
Potentially, yes, if all the conditions are met. It's made a big difference for many families passing on the family home.
Okay, now back to those lifetime gifts. You mentioned some can be drawn back into the estate. Let's talk about potentially exempt transfers, PTs. What makes them potentially exempt?
Right, PETs. These are typically outright gifts made directly to individuals during someone's lifetime. Think giving money or assets to your children.
Okay.
They're potentially exempt because if the person making the gift, the donor survives for 7 years after making the gift.
Then it becomes fully exempt, falls out of the IHT calculation completely.
Exactly. No IHT is due on it at all. It's completely outside the estate.
But if they don't survive the full 7 years?
And the gift fails to become fully exempt, and it uses up part of the donor's nil rate band when they die. If the gift's value exceeds the available nil rate band, IHT might be payable on the excess.
And is that where taper relief comes in?
Yes, precisely. Caper relief can reduce the amount of tax payable on the gift itself, not the value of the gift for NRB purposes, if the donor survives for more than 3 years, but less than 7 years after making the gift.
So the longer they survive within that 3-7-year window, the less tax is due on the gift.
Correct. The tax reduces on a sliding scale. Death between 3-4 years means 80% of the full tax is due, 4 to 5 years is 60%, 5-6 years is 40%, and 6-7 years is 20%. After 7 years, it's 0%.
A sliding scale of relief. Okay. How do these PTs contrast with chargeable lifetime transfers, or CLTs?
The CLTs are different because they can trigger an immediate IHT charge at the time the gift is made.
Immediate tax, unlike PTs where it depends on survival.
Yes. CLTs typically involve gifts into certain types of trusts or gifts to companies. If the value of the CLT, when added to any other CLTs made in the previous 7 years, exceeds the donor's available nil rate band at that time,
then IHT is due straight away.
Then IHT is usually payable immediately at a lifetime rate, often 20%, on the excess amount above the nil rate band. There might be further tax if the donor dies within 7 years.
So much more complex and potentially taxable up front. That's a key difference.
This is a very important distinction in estate planning, yes, especially when considering trusts.
What about gifts that are just exempt? No 7-year clock, no immediate charge potential, just straightforwardly exempt, like wedding presents.
Absolutely. There's a whole range of gifts and transfers that are simply exempt from IHT from day one. These are really useful for planning.
Okay, like what?
Well, first off, transfers between spouses or civil partners are almost always completely exempt as long as they share the same UK domicile status. That's fundamental.
Leaving everything to your spouse is tax-free.
Generally, yes. Then there are small gifts you can give away up to £250 to any number of people each tax year, completely exempt as long as you haven't used another exemption on them.
£250 per person. Okay.
Donations to registered charities or qualifying political parties are exempt. Gifts for national purposes, like to museums or galleries, are also exempt.
Encourages giving.
It does. Wedding or civil partnership gifts are exempt up to certain limits.
Yep.
£1,000 generally, but it rises to £2,500 if it's from a parent, or £5,000 if it's from one partner and the couple to the other.
Specific limits for weddings.
Yes, and a really important one. Gifts made out of your regular income.
Regular income, how does that work?
If you make regular gifts, say monthly payments to someone, and you can show they come out of your normal income, not capital, and making them doesn't affect your usual standard of living, then those gifts are exempt. There's no limit on the amount, provided those conditions are met.
That sounds potentially very powerful for regular support.
It can be, yes, but you need good records. Finally, there's the annual exemption.
Another allowance.
Yes. Everyone can give away a total of £3,000 worth of gifts each tax year, exempt from IHT. This covers gifts not covered by any other exemption, like a larger one-off gift to a child.
£3,000 per year. Can that be carried forward if unused?
Yes, but only for 1 year. So if you don't use your £3,000 allowance 1 year, you can carry it forward to the next, giving you potentially £6,000 to use. But then it's gone if not used.
Okay, lots of exemptions to potentially use there. This really highlights the need for planning. Let's try that detailed example from the sources. It walks through assessing an estate, considering various gifts made over the years. Assume the IHT rate is 40% over the £325,000 nil rate band.
Right. This example really brings it all together. Let's track the gifts.
Okay, year 1. A gift of £20,000 to a daughter.
Okay. In year one, the donor uses their £3,000 annual exemption for that year and the £3,000 carried forward from the previous year, assuming it was unused. So £20,000 minus £6,000 leaves £14,000. That £14,000 is a Pete.
Got it. Year 2, £40,000 to a son on his wedding day.
Here, we use the £3,000 manual exemption for year 2 plus the £5,000 marriage gift exception, assuming parent to son. So £40,000 minus £8,000 leaves £32,000. Another Pete.
Year 4, £5,000 to Macmillan Cancer Charity.
That's fully exempt as a gift to charity. Right. Value for IHT is £10.
Simple. Year 6, another £20,000 to a daughter, also on her wedding day.
Okay, use the £3,000 annual exemption for year 6 plus the £2,500 marriage gift exemption, parent to daughter, lower limit than spouse to spouse. So $20,000 minus $5,500. No, wait, the $5,000 exemption is for parents. My apologies. Let me recheck the example details. Oh, yes. It uses the annual exemption, £3,000, and assumes £2,500 marriage gift exemption applies, reducing the gift to £14,500. The source calculation seems to get £9,000. Let's reread. Perhaps they only use the annual exemption in specific wedding gift rules. Let's assume the example's outcome of £9,000 as the Pete value after exemptions for simplicity following the source.
Okay, so £9,000 Pete in year 6. Year 7, 2 gifts of £250 each to grandchildren.
Those are exempt under the small gifts rule, value £2 each.
Right. Now fast forward. By years 8 and 9.
The Petes made in year 1, $14K, in year 2, $32K, become fully exempt. Why? Because the donor has survived more than 7 years since making them, they drop out completely.
Okay, good for the estate. Now, year 11, the donor dies. Estate value is £600,000.
Okay, $600,000 total estate. But the example says £200,000 is left to his wife.
And that's exempt.
Yes,
Yeah.
spouse exemption applies. So the value subject to potential IHT is £600,000 minus £200,000, which equals £400,000.
Right. But what about that year 6 gift? The £9,000 Pete. Death was in year 11.
Exactly. The year 6 gift was made less than 7 years before death. Only 5 years between year 6 and year 11.
What?
So it's a failed Pete,
Meaning?
meaning its value, £9,000, now has to be counted against the donor's nil rate band. It effectively uses up the first £9,000 of the £325,000 allowance.
So the available nil rate band for the rest of the estate is reduced.
Yes. The NRB available for the main estate is £325,000 minus that £9,000 a gift £316,000.
Okay, so how much IHT is due? The taxable estate was £400,000.
You take the taxable estate of £400,000 and subtract the remaining nil rate band of £316,000.
Which leaves £84,000.
Correct. £84,000 of the value actually subject to inheritance tax.
And at the 40% rate,
40% of £84,000 is £33,600. That's the inheritance tax bill on the estate.
wow. That example really shows how all those different gifts, exemptions, timings, and the spouse transfer interact. You can really see the impact of that 7-year rule.
Absolutely. It demonstrates why keeping records of gifts and understanding the timelines is so crucial for IHT planning. A few years here or there can make a big tax difference.
It really makes you think about planning ahead, doesn't it?
It absolutely does. Understanding these rules helps ensure more of your legacy goes where you intended to.
Okay, we have navigated, I think, 2 of the most perhaps complex areas there, capital gains and inheritance tax. But our roadmap of the UK tax world wouldn't be complete without quickly touching on a few others that affect us maybe more day to day or certainly affect businesses. We'll keep these as quick hits just for that broader picture.
Sounds good.
First up, value-added tax, VAT. We all pay it constantly, don't we? But what is it, fundamentally?
Yeah, VAT is everywhere. It's an indirect tax, a consumption tax, really. It's added to the price of most goods and services supplied by VE-registered businesses in the UK.
Most but not all. You hear about things being exempt or zero-rated. What's the difference? It's a bit confusing.
It can be, yes. Some supplies are genuinely exempt. Think financial services, insurance, some education, and health services. Businesses making exempt supplies generally can't reclaim the VAT they pay on their own costs related to those supplies.
Okay, and zero-rated.
Zero-rated is different. VAT is technically charged, but the rate is 0%. Crucially, businesses making zero-rated supplies can still reclaim VAT on their related costs.
Ah, that's the key difference for the business. What sort of things are zero-rated?
Things like most food you buy in supermarkets, books and newspapers, children's clothing and shoes, public transport fares, also things like domestic water supply or heating fuel are often subject to a reduced rate, which is another category again.
Right. And when does a business actually have to start dealing with all this? When do they register?
Businesses must register for VA if their VAT taxable turnover. The value of their non-exempt sales goes over a certain threshold in a 12-month period. It's currently £85,000.
And why might a business not want to register, even if they could voluntarily below the threshold?
Well, two main downsides. Firstly, it makes their prices higher for customers who can't reclaim VAT themselves, like the general public. Secondly, it means extra admin, keeping VAT records, filing returns, paying the tax over to HMRC.
Okay, VAT covered. Next quick hit. Stamp duty. Sounds very old-fashioned. Stamping documents?
It does have old roots. Originally, yes, it was a tax paid by physically stamping documents to make them legally effective. Now it's a bit more complex.
Oh, so?
There are actually a few different types. There's stamp duty itself, which mainly applies to buying shares using a paper stock transfer form. Pretty rare now.
Okay.
Then there's stamp duty reserve tax, SDRT. This is much more common. It's charged automatically when you buy shares electronically, through a broker, for example, usually 0.5%.
Right, the electronic version.
But the big one most people encounter is stamp duty land tax, SDLT.
Ah, the property one.
Yes. This is paid by the purchaser when buying property or land in England and Northern Ireland. It's charged at different rates depending on the property price and whether it's residential or commercial.
And I know there are different rules, like higher rates for second homes.
Exactly. There's a supplementary charge if you're buying an additional residential property, like a buy-to-let or a second home.
But there's help for first-time buyers.
Yes, thankfully. First-time buyers often benefit from reduced rates or complete relief on SDLT up to a certain property value. It's designed to help people get on the ladder.
And important to note, Scotland and Wales have their own separate property taxes, right? Not SDLT.
Correct. Scotland has Land and Buildings Transaction Tax, LBTT, and Wales has Land Transaction Tax, LTT. Different names, different rates and bands, but similar concept.
Okay, stamp duty's sorted. What about corporation tax? Who pays that?
Corporation tax is paid by limited companies and also by some other organizations like clubs, societies, associations, cooperatives.
On what?
On their profits. That includes profits from trading activities, any capital gains they make when selling assets, and also investment income like interest received.
And does it matter where the company is based?
Yes. UK resident companies are generally liable for corporation tax on their worldwide profits. Non-resident companies, so those based overseas, usually only pay corporation tax on profits arising from their UK activities, like through a UK branch.
Right, tax on company profits. Final one. Withholding tax. What's being withheld?
Tax is being withheld. It means tax deducted at source before the income is actually paid out to the recipient.
Where might you see that?
A common example is on certain payments made from the UK to non-residents, like interest or royalty payments. Tax might be withheld by the UK payer and paid over to HMRC.
Does that mean the recipient gets taxed twice? Here and in their home country?
Hopefully not. The UK has double taxation treaties with over 100 countries. These treaties aim to prevent double taxation, often by allowing the tax paid in one country to be credited against tax due in the other, or by setting reduced withholding tax rates.
And this applies to people like visiting performers, too.
Yes, there are specific rules often covered by these treaties for non-resident entertainers and sports people performing in the UK to ensure tax is paid appropriately but fairly without double hits.
Wow. Okay, we really have covered a huge amount of ground today, a proper deep dive going way beyond just income tax.
We certainly have.
We unpacked capital gains tax, those exemptions, the reliefs, even that old bed and breakfasting trick.
And how the 30-day rule stopped it.
Then inheritance tax, the nil rate bans, transferring them, the residence nil rate ban, and that crucial 7-year clock for potentially exempt transfers.
Plus all those useful lifetime gift exemptions.
And then we did the quick hits. VAT, the different stamp duties, corporation tax, withholding tax. Phew. I feel like this look at your source material has given us a really solid but hopefully digestible overview of these other important UK taxes.
I hope so. It's really about seeing how these pieces fit together in the bigger picture of our financial lives, isn't it? They pop up at different moments, often significant ones.
Definitely. So, having gone through all of that, what does it all mean for you, listening, thinking about capital gains, inheritance tax, VAT, stamp duty? Which part of this wider UK tax system do you find most maybe intriguing or surprising? Or perhaps, which of these taxes we've discussed do you think actually has the biggest hidden impact on most people's everyday financial decisions, even if they don't always realize it?
That's a good question to ponder.
We've given you the nuggets from our deep dive. Now it's over to you to think about how they shape your own financial landscape.